How to day trade in less than 30 minutes in 2026. Let's get it, man. Make sure to leave a like and comment for more videos. Subscribe if you guys are new. I'll see you guys in the next clip. I'm so excited to see you guys here. My name is Caleb Baker. I'm Go by CB. This is my Continue Believe channel. Hope you guys are doing good. You guys are here. You guys are trying to learn to trade, so let's get right to it, man. All right, you guys. So let's start from the top. What is day trading? Simply put, day trading is buying and selling stocks, options, or any assets within the same day. That's it. No overnight risk, no holding positions for days or weeks. It's very, very simple. So if you guys are trying to learn to day trade, that's all it really is. All right, so let's move on. Who's day trading for? Day trading is for people who are disciplined, who have the ability to make fast decisions. They have control over their emotions. That's very, very important. If you guys are not in control of your emotions, when you start day trading, you're probably gonna learn about how to control your emotions and how to just be in more tune with yourself as a person when it comes to your emotionality control. Ability to stick to the plan, that's gonna be very, very critical in risk management. We'll talk about that in the future here soon. Time to watch the market. If you have time to watch the market, you have time to pretty much put towards looking at charts and looking at the candlesticks and things like that, then you'll be able to day trade. It's not that difficult. It's really not. You don't need to be a genius. You need structure, patience, and emotional control. Those are the main things. 90% of new traders blow their accounts because they trade without a plan. They don't have risk management, revenge trade, overtrade. They have no journal and they don't strategize. Guys, you gotta do all these things. Do the opposite of everything I just said. If you do the opposite of everything I just said, I promise you will see some form of success with day trading. All right. Your goal is just to find one good day trade a day. That's it. One good day trade a day. You really just need one, and the consistency of one good one a day will help you compound your results quicker. Essential things you need to know. The stock market hours. Pre-market's from 4 a.m. to 8:30 a.m. Central Standard Time. Normal market hours are from 8:30 a.m. to 3 p.m. Central Standard Time, and the market after hours are from 3 p.m. to 7 p.m. These are the hours you can trade. Most beginners should stick to the normal market hours, just because it's simple and it's cleaner and it's more predictable. What moves the market? News, earnings reports, economic reports, volume, price levels, market sentiment, things of that nature typically move the market up or down. The basics of candlesticks. How to read charts. It starts with candlesticks. And what exactly are candlesticks? Candlesticks are what help people tell a story the market is showing us. The open, the close, the high, the low. The battle between buyers and sellers. So a candlestick, when it's green, that means buyers are winning. When it's red, that means sellers are winning. Depending on where the market candle opens and closes, that'll determine what makes a candlestick red or green. So if the candle opens at $50 and it closes at $51, then that's a green candle. But if the candle opens at $50 and closes at $49, then that's a red candle. So you guys want to be mindful of that, and that's pretty much how a candlestick works in its very, very simplistic form. All right. What is volume? Volume is dictated upon how many people are buying within a certain candle time frame. So if you're looking at the 5-minute time frame, it's valuing how much volume is being poured into a candle within 5 minutes. And at the bottom of your chart, you'll see these little bars showing you the strength or the weakness of a volume candle. So if you have a strong volume candle, it will show you a very long, very large candle. If you have a weak volume candle, it'll show you a very small and shorter volume candle. And what these identify is how much buying and selling is happening within that particular stock. This is good for you to identify momentum and how well a stock's moving and how much flow you have in a stock. Bulls versus bears. These are terms we use in the stock market when it comes to day trading. A bull candle means that buyers won that candle. Like I just said, $50 to $51. And then a bear candle, a bearish candle, means that the sellers won that candle. So like I said, $50 to $49, okay? Simple, but very, very powerful. Wicks. A top wick means that seller stepped in. So if a candlestick opened at $50, it went to $52, but it closed at $50, then that means when it hit $52, the candlestick rejected $52 and came back down. And you'll see a skinny little line form right there showing that the seller stepped in. However, if you see a candlestick go from $50 to $48 back to $50, then that means the skinny line that formed at the bottom means that buyers stepped in. Top wicks show where the price rejected, and bottom wicks show where the price bounced. Risk management. How to stay profitable. Protecting your money is the key to building a profitable account. In other words, becoming a profitable trader comes down to being able to protect your money and protect your cash. If you want to have the mindset of a great trader, you got to think logically. You got to stay calm. You have to follow the plan, and you can't chase. Don't ever chase a trade. There's so many opportunities in the market. There's no need to chase a trade. I promise. Understanding risk to reward. What is risk to reward? Risk is what you're willing to lose, and reward is what you're willing to make. Never risk more than you want to make. That is very important to know. So if you're trying to risk $2 for $1, that's not smart. You should not do that. That's gonna make you lose more money if you end up losing. However, if you're trying to risk $1 for, let's say, $5, that's good. That's a good risk to reward. You want to risk less and be able to be rewarded more. Always, 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 always. My personal strategy when I'm in the market, I risk no more than 10% of my account value per day. So if I lose, for example, if I have a $5,000 account, if I lose 10% of that account, which means if I lose $500 in that account in that day, I'm done trading. That's it. So I don't want to lose no more than $500 in my account per day. And that allows me to be able to take trades and be comfortable in my positioning to know that if I lose 500, then I'm done for the day. It could happen all in one trade, or it can happen in the span of trades. It just depends on how I go about the trading day. Things you want to avoid: over trading. Over trading is caused by boredom, fear of missing out, in other words, FOMO, or chasing losses. You guys never, never, never want to overtrade. This will be the number one way that you guys will blow your accounts. You guys want to be mindful and cautious of where you're at emotionally, and be in tune with your emotions and knowing whether or not this is a smart trade or this is me just being bored and trying to take a trade. You guys do not want to be caught up in that mix of overtrading, because that is the quickest way to lose money in the market. Another thing you want to avoid is emotional traps. Fear, greed, and revenge trading. Those are the main emotions you'll feel when day trading, so you guys just want to be mindful of that and be in tune with your emotions and know that how you feel before you take a trade is very important, because it'll allow you to identify how comfortable you are going to approach that trade and whether or not it should be a trade that you should take. Because your mental is another thing that plays a big part into trading, because the market's built to go up, but it's also built to manipulate you when day trading. So if you're trying to take a trade and you're not confident that the trade's gonna work, just don't take it. There's no reason to force a trade, because then you're most likely going to feel fearful and feel a little bit of greed depending on where it's at and how it's moving. And then if you hold too long, you end up losing, you'll burn out emotionally and then you lose money. So it's not worth it in the end. If you hit your daily loss, walk away. There's no reason for you to continue trading. Stick to your plan. If you had a set number that you said you would not trade after hitting, hit that number and walk away, whether it's a profit or a loss. If you lose the amount of money you said you would be done trading after you lost it, walk away. If you hit the target that you said you wanted to hit for the day, walk away. There's no reason to stay in the market after you hit the desired outcome one of the two ways, because after that, you're just going to either give back money or lose more money, and you never want to do that. All right, let's talk about patterns, the gateway to a great strategy. First up, we have support and resistance. Support is where the price tends to bounce up, and resistance is where the price tends to go back down, or in other words, reject. The idea you take when playing a support and resistance is you're either going to take a trade off the support level or you're going to take a trade off the resistance level. This is a very critical thing if you have a way of analyzing a chart and knowing where there's major levels of support and major levels of resistance. This is very, very critical in helping you become a better trader, because if you have a strategy like support and resistance, it's very, very good to identify risk and return. And regards to how high it can go and how low it can go. Because after you break a rejection level or a resistance level, then you know that, okay, if I break above this level, I can lose this much. But if I break below this level, I can make this much if you're trading resistance. If you're trading a support level, you have a risk defined right below that level. So you know that if it closes below this support level, then that's my risk. But if it bounces off the support level and goes back to resistance, then that's my reward. And the reward can be a lot further than the risk. So that's the support and resistance trading strategy. Hey, what's good, you guys? If you guys are new to this channel, make sure to leave a like, comment, and subscribe. I would appreciate that so much. Also, check out my website, continuebelieve.com, if you guys want more information about day trading and investing, where I can share all my tips about everything I know about investing and so much more to come very soon. So check that out, link in the bio, or you just type www.continuebelieve.com. I'll see you guys in the next clip. Peace. All right, trend lines. What are trend lines? Trend lines, simply put, are a line you watch the candlesticks form a trend on, and you can literally draw the line going up or down to show you lower lows and lower highs, or higher lows and lower highs. One of the two. And I think I said that wrong. It might be the other way around. So you want to look for higher highs on an uptrend. What you want to look for is higher highs and higher lows. So anytime a candle goes up and comes back down and then goes right back up, it's forming a higher high, then a higher low, then a new higher high, another higher low, right? So that's just a visual example. And then for a downtrend, what you want to look to see happen is it go down, up, and down. What you guys want to see is a lower low, lower high, lower low, lower high, and so on and so forth. So that's a trend line strategy that you guys can use whenever the market is in an uptrend or a downtrend. You guys want to be mindful of those kind of trends. Those are very powerful trends that can help you make more money in the market. And you can just use a simple break of trend as a stop loss. So you guys want to get in at the very next lower low or higher low, and then use that break of the high low as a stop loss for your risk management to be the best possible risk management in that position. Next up, we have consolidation. Consolidation is the exact opposite of a trend line. It's no trend at all. It's basically a barcode where it just goes up and down in between a rectangular formation, and it's pretty much bouncing off support and resistance. And so what you guys want to look to see or do in this kind of position is basically take a bounce off support or a rejection off resistance, and that's it. Because it's not going higher and it's not going lower, it's just going back and forth. Depending upon how much the risk to reward is in that zone, then it's worth it. I don't prefer this method just because you can lose money because of the manipulation that market makers can do in this particular strategy. However, it is still a powerful strategy if used in the right scenario. So consolidations is something you guys want to be mindful of. We had a consolidation week this week of my recording. The very first week of December, SPY was super stuck in the consolidation mode between 584 and 580. It was a valuable trend to take the consolidation off of if you caught the right entry. So consolidation is another trend to be mindful of. Let's move on. Let's talk about breakouts. So what is a breakout? A breakout, simply put, is when a price breaks above resistance or below support. So in a breakout trade, you guys want to see a break and retest. Okay, so we break resistance, then we retest the resistance level that we broke above, and then we get a bounce off of the resistance. And in a breakdown strategy, you guys want to look for a break below support and a retest of that support level, and then another rejection back down. And what this does is it allows confirmation to confirm your trade entry being the new trend, the new transition to the downside or to the upside. So breakouts are a very powerful trend and trading strategy to use within the day trading space. So you guys want to be mindful of breakouts and breakdowns. These are a few other candlestick patterns you guys want to be mindful of. We have the hammer, the shooting star, the engulfing pattern, and the pin bar. The shooting star and the pin bar are very similar. Only difference is the size of the candle itself and the size of the wick. The main things you guys want to pay attention to also is where these patterns are being formed. If they're forming at levels of resistance or levels of support, then these are more likely to go a lot further and do a lot more if they form off of those kind of levels, because it's now adding more reason to why the trade could work. For example, let's say you get a pin bar off of support on a 4-hour chart, and we're bouncing off of a demand level from 4-hour chart going back into a new resistance that's $10 away. That is a very critical trade to take, just because of the pin bar and the bounce off of the 4-hour demand. The 4-hour demand is a very strong demand in the market, so if you get a pin bar or something like that, that's something you guys want to take instantly, no brainer. So yeah, these are candlesticks to be mindful of. There's so many other candlesticks to learn, but these are just the main 4 that you guys want to keep in mind and look out for whenever you're trading. Exponential moving average, otherwise known as EMA. The EMA is an indicator utilized in day trading and also swing trading, where it averages out the average amount of candlesticks depending upon how many candles you're looking at. So you can use the 8 EMA or the 9 EMA, which will pretty much average out the 9 candlesticks or the 8 candlesticks that it's used in the last 5 minutes, 10 minutes, however long you're looking at the time frame, and it'll dictate what's the average cost that it's moving at in order for this line to hold. And it's pretty much creating a line as you go throughout your trading day. So what this does is it's a very powerful tool to use depending on how you use it in your trading strategy to make money, because it can formulate a new trend for you to know a guidance behind where your trend line is at, and you can use this to make money. Anytime it breaks above this trend line, it can be used as a breakout, or it can be used as just following a trend line to the upside. As long as it holds, in some cases you can use this as a trailing stop, or you can use it as an entry point, depending on how you go about trading. So for me, for example, if I were looking at this trend line, if I were looking for an entry, I would use the 9 EMA and then look for a retest of the 9 EMA and then a bounce off the 9 EMA, and I would use a stop loss below the 9 EMA as a trade entry. You can do that with the 15-minute, the 1 hour, 4-hour, however long you choose. Like I said, just depends on how you go about your trading strategy. So the EMA is a very, very useful tool if used properly. VWAP. VWAP is the similar to EMA. Only difference is averaging out the volume per candle. It'll give you an average price that it goes towards throughout the day, and that's the value that it will move at, depending upon how much volume is used per candle. Okay, so it might be right at the EMA sometimes. If not, sometimes it might be a little bit below it, just depending on where you're looking at it at, what time frame, how much volume is being used in the market, things of that nature. Anytime you get a break from VWAP above EMA, that's an indicator that the market's going back up. And anytime you get a break below, VWAP break below the EMA, that's an indicator that the market's going down, depending on the time frame, especially 15 minutes and more. And normally is when you get a confirmation of these kind of moves. All right, so that's the VWAP. Let's move on. Reflective Strength Index, otherwise known as RSI, it measures the momentum. So anytime the market's above 70, that means that the market is overbought. And anytime the market's below 30, that means the market's oversold. When the market's overbought, that's an indicator to look for some calls in a position, or maybe a swing to the upside. And when the market's oversold, that's an indicator to possibly look for puts or rejections to the downside. Anytime you get a pattern set up with the RSI, like a bullish divergent pattern or a bearish divergent pattern, you guys should look that up. It's a very, very critical pattern to use in swing trading or day trading in order for you to catch some good moves. You guys can make a lot of money from that just by using the RSI. So let's deep dive a little bit more into trading strategies and go a little more in depth into ways you can win. This is a more critical breakdown of trend and how you can identify it. So like I said, your stop loss, I defined what your stop loss would be in a trend. If you got a higher high, you would typically look for a higher low to get an entry, and then use that higher low entry as a stop loss. So if you break back below that higher low, that would be your stop loss in that position. Typically that's about a one risk to 2 reward, maybe 1 risk to 3 reward kind of thing. It just depends on the stock and depends on the way the stock moves in order to identify what your risk to reward would be. What you can do in these kind of scenarios is now implement the EMA indicator to identify where your entry and exit could be. Because as I said, if you pair these things where you have the trend line to the upside and the EMA to the upside, both forming to higher ups, then you can use that EMA as an entry point and then use that EMA breakdown, if it ever breaks back below the EMA, as a stop loss if it's trailing the EMA. If it's not trailing the EMA, disregard this plan. But if it's trailing the EMA, you guys want to follow the trail and get in on the EMA test and then use the EMA test as a stop loss. It's a very, very important and key way to get some gains out of the market if you're new to trading and you're not trying to overthink trading. That's a good way to go about trend lines, using the EMA as an indicator and entry point for you to enter and exit your trades. Another strategy to look into is called the orb strategy. What is the orb strategy? It's simply the opening range breakout. The first 15 minutes of the market, you let it set up, and then you set the opening range high from the highest candle that was tested and the opening range low from the lowest point that the market tested within the 15 minutes. Anytime you get a break above or below is then when you want to look to take a position. And then your stop loss would be a break back into the orb low or orb high, and that's your trade strategy. This is very critical and useful in scenarios where you have a lot of volume. The orb forms around levels that are closer to support levels or closer to resistance levels. So let's say, for example, your orb low sets up at a support level, and each time it tests that level, you see a strong bounce off of the orb low. Well, if it's showing failure to close below the orb low, then that's giving you indication that the stock does not want to fail, and you can use that failure as a stop loss if it fails. However, if it bounces, you can use that bounce to the upside as the reward. So that would be your risk to reward. Now let's say, for example, you have a resistance level set up at the orb low. So now your orb low is actually a resistance level that it shows a strong break back down below on the opening bell of the market. We break back down below the orb low and we retest the orb low. Now I want to use that retest as the entry, and then if you fail to hold below the orb low and you go back above the orb low, that is your stop loss. So a break below orb low, essentially a break and retest below the orb low. So you break below it and then you retest it, which was actually your resistance level, and it's the orb low. That is now your stop loss. If you go back above the orb low, you stop out. However, if you go retest and reject again, now you're in a risk to reward trade that can give you 1 to 3 risk to reward. Depending upon the stock, depending upon the chart, these are strategies that you could implement on a lot of charts. So orb strategy is another strategy that I recommend. Moving on, we have the momentum strategy. Momentum strategy is a little more trickier, a little more advanced, just depending upon the trader. And you want to be mindful of what the momentum is. So the momentum is based upon, like I said, the volume candles, how well the market's flowing, and how many people are buying and selling the stock. I like to pair momentum with trend or orb, because if I have strong momentum and I have a strong trend, then that gives me more conviction in the trade to go in my favor. However, if I have low momentum and I have a trend, I would still take the trade because it's trending, and I would be confident in the trend holding if it's a strong trend. However, if it's weak momentum, you don't want to take a trade with weak momentum and no trend, because the trend is really what's going to help guide you to winning. So momentum should not be taken just purely off of momentum without any kind of plan or structure or strategy in place. You guys want to have some form of strategy, whether it's a retest off demand or resistance. It just depends on what your idea is behind the momentum usage. So be mindful of that. But momentum is a very, very, very useful tool if used properly. So momentum, orb, and trend lines are going to be the 3 things that I recommend you guys look into in regards to strategies, and utilizing those in 2026 will help you be an effective trader. There's many, many more ideas and ways to go about trading, and there's no right or wrong way to do it. Bottom line is, like I said, becoming profitable just comes down to having good risk management, having good emotional control, being able to make quick decisions on your feet, and having a plan. As long as you have those 4 things, you will become a good trader. But the main thing overall is definitely risk management. The more control you have over controlling your losses, the better trader you can be. That's going to be the most critical thing for anybody who's trying to day trade, is just how well can you manage your losses. The better you manage your losses, the better you can win and see more results in the future. If you guys like this video, make sure to leave a like and comment. Subscribe if you're new. I will be releasing more videos like this in the future, so stay tuned for that. Turn on your notification bell, and I'll see you guys in the next one. Peace.